Great. Good morning, George. Hi,
Morning,
Michael.
Good morning. Good morning, everyone.
The wrong one. Microphone here. Speaker. There. Okay. Can you hear me okay? Good.
you sound like you got your radio voice on today.
I'm sorry?
You sound like you've got your radio voice on. It's all
Ladies and gentlemen, boys and girls, children of all ages, gather around for another fun-filled episode of
You shouldn't do that because he also was an actor in college.
I was an actor in college.
Is that right, George? Were you?
Yeah. I did all throughout high school and college. I was very seriously into theater.
Oh, wow.
And that would have been a fun career, but I'm too conservative, you know. I couldn't see the
pros.
I couldn't see the path. So, and plus I'm not that talented, let's face it, but I did have fun. So, yeah.
With your lawyer background, you could have become an agent for somebody, right?
Could have, or, you know, I would have enjoyed, I think I would have enjoyed litigating, but I was really drawn to regulation and, you know.
So you must be reading up about now what do we do with streaming and what do we do with AI for all the actors and actresses and singers?
You know, it's years ago, I met a woman on the plane she was an attorney working out of Nashville. She went to a fairly prestigious school and she was in Nashville, and she said she was one of only 4 attorneys in all of Nashville that she was aware of who were working on these kind of licensing issues. And she was doing okay. She was doing okay. Hey, good morning, John. So, yeah, what's on everyone's mind this morning?
George, I have a question for you.
Go ahead, Mike.
I was talking to my daughter this morning over breakfast, and she just recently was hired on by a company called LexisNexis. I think you probably
know them well. Yeah.
So she's starting there, and you know, she's in a sales role, and they're training her in this concept, this technique of doing a profit proposal to a prospect, essentially telling the prospect that, you know, by adopting, you know, LexisNexis's technology and services and security, you know, they would save so much time and money, and you know, that's what they try to impress upon the folks they talk to, is that, you know, we're going to save you time, we're going to save you money. And that's kind of the crux of their cold calling, if you will. Although, as she says to me, I have to cold call, but no one picks up the phone after 90% of the time. But anyway, so with that said, I wonder, like, with regard to the growth, you know, Clarity or Clarity 2, are there any statistics that you have accumulated which demonstrate that by going through the Clarity process, companies can increase their value by a certain percentage? I mean, is that a number, or is that a statistic that you could put out there that would be somewhat backed up by data?
Sure. You know, it's so funny. You guys are going to think that Mike and I coordinated this. Okay, no. Mike, that is a great question. And there are sort of 2 layers to the answer. One is that you guys all know, you're here, that you increase your efficiency and effectiveness by having a deep understanding of the business, right? I think it is a great argument to say to the CEO, listen, we can put a process in place with demonstrated waypoints, with measured waypoints, where you're going to have an impact on your value, and we can do it in a very time efficient fashion and with a proven track record of success. Mike, I'd have to let me think about the actual wording of the argument, but your argument is a good one. And it's the reason I started laughing is that I was planning on sharing with you guys, if you're interested, designing what I've nicknamed CFO Insights. Probably won't be the street name, but CFO Insights. What can we, if we start modeling, looking forward, what does this look like for the CEO? And at points when they've, you know, you have done X, here is the Y result at these points going into the future. And so, Mike, I don't think, maybe I answered your question partially, but that's a great question. So, and that would be helpful. One of the other things that's happening behind the scenes is you've seen me put out a few client-facing articles, right? We are going to up that game a bit as well and we are designing a complete package that you can deploy. So we don't want to become a marketing business, but it certainly makes sense to help you better communicate with clients and prospects, win engagements. You know, my mission is to connect you guys with private business CEOs, business owners, and we need to get their attention. So I want to help you get their attention.
Mike, one of the things that George is trying to do is get people who have in the group here have actually done something with a client and then do a case study.
Yes.
And those case studies would be the best place to have it.
Mm-hmm.
Just doing Clarity 1 or doing Clarity 2 doesn't achieve the results, because you can lead the horse to water, but you can't make them do something about it.
You have to kick them in the withers. Yeah.
The withers?
Yeah, why not? Just go with that. I'm going with horse terms. But that's a great point, Paul. And you are about to all receive a request for a candid testimonial, right? And that's coming your way. But case studies, we have a case study building model, and it's in Circle. I'm happy to send it to you and increase your profile right out in the market. And it's really, what was the issue the client wanted to resolve? What is the best practice for resolving, or best practices for resolving that issue? When you applied the best practice to the client's issue, what was the experience? And then conclude. What was the result, either experientially or in business terms? Issue, rule, application, conclusion. Actually, it's something that lawyers are taught from, in the earliest days of law school, and it is a very effective way of communicating. So, Paul, thank you.
You're welcome.
How's it going? I got to see Joe face to face this weekend. How are you, Joe? Good morning. Went up. I think you all know, Ed's wife passed away and passed on, and so I flew up. The memorial service was on Saturday up in Ohio. A shock to drop out of the clouds and see a landscape of snow. My brain hadn't really thought that far forward. So would you go ahead, Mike? I see you.
Okay. So I was going to ask you. You said there was a case study in Circle. Where would I find that?
The case study. Let's go over. I'm opening it up right now on my other monitor. Case studies. Okay, I just put case in the search bar.
Okay.
There's one published, and there's click here for the online case study builder. So it's
I see it
there. And we do. We have a lot of institutional experience with Clarity, and
so what is this? I mean, this looks like it looks like something you have to complete, right? Fill out.
Yeah, that would be, if you wanted to build a case, that's how you would do it. There's a case study there's the Ridge Specialty Tooling case is here, it's an 8-page case study. So maybe I ought to dust this off and take it out around the block. Make a great blog post.
Is this the one that says applying the 3 dimensions of business growth? Oh, okay,
You've got it.
Okay, gotcha. Okay.
And what we're doing, well, it'd be fun to have more cases, and that's up to you guys. Sounds like a workshop is in order. Go ahead, Steve. You don't have to put your hand up. This is a conversation. I don't want to be the hall monitor. Go ahead, man.
This is off of that topic, but I think, George, when people do Clarity 1, the average is someplace in the 50s.
Yes.
Okay. I had a guy last week did it, and he's 82-ish. How often do you see that? Just out of curiosity.
So, how big is this business? Gross?
30 million revenue.
Okay. I would view that with skepticism. I will tell you the answer to that question on a percentage basis right now, if you give me one moment. I would view that result with skepticism. Now, 30 million, that's a successful business. I don't know, in 13 years of experience with this type of conversation, my guess would be that when you do the deep dive, suddenly when we get to the show me state, suddenly it's like, well, we don't really have that. Oh, you mean written down? Well, no, we just do it. It's that type of, in my experience, that's where the conversation goes. Bear with me. Here it is. I will tell you how many 82s there are. Yes, Gemini for Google Workspace, guys. I just added it this morning. I have no experience. I just got the pop-up here. Very exciting. AI and Gemini is powerful. By the way, let's just a little digression onto AI. I personally use AI a lot, right? I use it. There are some really good AI-powered software services out there, SaaS products out there. And then Gemini and ChatGPT are just getting better and better. And it is fascinating to put exactly the same prompt. I'll start in chat and copy and paste it into Gemini or vice versa. And it's fascinating. They will typically come up with similar, sometimes uncannily similar answers, but it's fascinating. I would get in the habit of doing it. It takes 1 sec to get a sort of a second look. Okay, how many at 82? Here we go. We're going to sort. It is the average, as I said, above 80. Yeah, that's just baloney. I don't want the sum. I want the count. Okay, somebody divide 11 by 500. 11 of a little under 500. So there's your answer about.
It's 2.2%.
2.2%. You have a 2% chance. And I'm it's great if they're really there, that's fantastic. Now let's talk about at 82 their growth capacity is going to be high and their value capacity is going to be high. I tend to but the short answer is trust but verify. And I think when you do the deep dive, you're going to whittle away. Maybe not profoundly, but you're going to whittle away. The other thing about scoring, guys, is an 85 is incredibly hard. And I will do a blog post. Maybe I'll do that blog post this week. An 85, it's exponential. This is like decibels or the Richter scale. Getting a 50, our average, I'm in the wrong. I'll tell you the average is 53 point. The average here is 52.55. So 53, right?
Yeah. George, can I just add something quick? I would also I just did one the other week. And I also think it's important to kind of I wanted to see how they scored relatively in dimension 1, dimension 2, dimension 3. So even if you're everybody's probably going to have a different are they marking themselves really hard or are they kind of being a little bit lenient, right? But I do think that it's important for me to sort of understand hey, if you're doing well in dimension 2 and dimension 3 but you're weakest in dimension 1, well that tells me something. Right, because presumably you're marking yourself at the same degree of difficulty. So it tells me that regardless of what the actual raw score is, you still got some issues to work on in dimension 1.
Yeah, absolutely. Go ahead. Yeah, man, John.
George, John, and Lincoln. Could we also get the median and the standard deviation on the data set that you just looked at?
Yes.
Thank you.
But not on the fly.
Okay.
Yes, and what I'm doing with this is I'm looking at median revenues, et cetera. It's something I actually am planning to look at this weekend, and there's some really good data in here.
I also want to underscore David's request for information by growth dimension. Those will be useful conversation starters for our people. Interesting.
And just in the by the way category, since I brought it up, this guy did score lowest in the first dimension.
Well, okay, so let's talk that through. Okay, so I started to share that getting a 53, getting so your entry level is relatively easy. You're going to be somewhere between the partly trues and the not reallys, right? There's a blend of partly trues and not reallys. You may have the odd, yeah, we're good at that, and you may have the odd. Actually, I don't even know what that is. Getting to a 70 is an exponential jump, right? It is not a, oh yeah, we'll just add, we're just going to add 15, 16 points. We're going to be good. It is an exponential jump. It'll take a year. I would anticipate a year or more to get to really, truly, really get up to a 70. Not with fooling ourselves, but really being able to document it. I can prove it. Cool. Getting from a 70 to an 85 is another. If we think in terms of someone coming into the system at a 50, mid 50s and getting to an 85, I would budget 2 to 3 years. This is difficult stuff because there are a lot of reasons for that. One of them is that as we grow, we break things, right? So this is the analyze, design, execute. We got to go back to analyze because suddenly you're like, oh, operations can't take all these new orders. We got our marketing machine going. Our sales process is churning along, and now operations is overwhelmed with orders, or customer sat is down, or we're running out of cash, and we got to go back and look at our cash flow. This is growing a business is not easy, and there's a reason that it's only a small percentage of businesses can successfully complete due diligence as they're run today, and that reason is that it is a very tough. It's a very tough standard, and we don't sandbag. We're not going to. This isn't the scoring doesn't give a trophy to everyone. The scoring says, "Hey, man, there are a lot of C students here. You're a C student, and you're not going to Harvard. I'm sorry."
George, I would assume that you would expect it's going to look like a bell curve.
Yeah, it's absolutely going to look like a bell curve, and I'll plot all that stuff out. Hopefully, Gemini will help me do it. What we did. So, any other questions on that before I
want to make one comment because I've been an EOS integrator for a number of years.
Yep.
So documenting something and feeling confident that your documents are in place is not necessarily adopted by all.
Yes.
So I think that's also a lever that you can have all the documents sitting in a nice notebook or sitting in a nice CRM tool or something. But if all your sales team are not following the sales process and you can prove that they're doing it, you got a lot of useless documents. So you can't really just check the box because you have a document. They need to prove it's adopted by all.
Thank you, Kathy. Love that observation, because it's right. And you'll notice inside Clarity it says, and used by all, and referred to by all, and discussed routinely. And, it has to be a standard if everyone isn't doing it, then we don't know if the process works or not, right? If the process exists but it's not being policed and it's not being measured, then we have no idea. And when we sit down, let's just take it to a transaction. We sit down at the deal table. And it's like, when they were like, oh, this is a great sales process. Well, nobody uses it. They just do their own thing. Well, now suddenly you've burned your credibility. And Kathy, that's a fabulous point. And I would add, we always talk about a third-party sale, private equity coming in, et cetera. That's the blog post I have drafted, it does not matter what are our exit options, right? You can IPO, great. How often does that happen? Don't have to answer, but hen's teeth. We have third-party sale, private equity or strategic, great. That is also a tiny percentage of the market. But then where do most businesses change hands? They have an internal transfer, right? Maybe a management buyout, or they may transition it through some mechanism, gifting or otherwise, to the next generation. They can do an ESOP. There are a number of different ways to monetize the value of the business. Some of them, get a wire right away. The others, we have more often than not, right, guys? We have the business owner, the founder, holding the paper. How much do you care about predictable profits and cash flow if you're holding that paper? How much do you care about predictable, sustainable growth if you're holding that paper? If you are the bank for the management buyout and they need to pay you out of cash flow, you care very deeply about these things. So it's not simply and I know you guys get this, but I'm on a roll. But it's not simply for a third-party sale. The three dimensions matter deeply for any type of transfer.
I would agree with
possibly
that.
Possibly even liquidation. Go ahead, Mike.
No, I would agree with that, George. Even if you're not going to be holding the paper on the sale, for instance, let's assume that your key employees do get outside third-party financing, let's say from the SBA or what have you. I have a client that's in this boat right now. He wants to make sure they're successful, even though he's out. So, yes, he wants to make sure the company is cash flowing well and is performing well, because even though he's not at risk, he doesn't want his successors to be at risk, right?
Absolutely.
And the same thing holds true with children too, right? Even if you're not selling, you're gifting or you're giving it to them. I think walking them and going through the process of going through, making the improvements necessary to bring one score from 53 to 85 with your children, kind of is almost a succession plan, in essence. So. Yeah, I agree with you. It doesn't matter, because everyone loves to talk about the strategic buyer and the private equity firm, but not too many companies.
Not too many. You're right.
They're not really of the right size for that kind of buyer. They don't have the right numbers. I mean, if your EBITDA is under $1 million or $1 million or less, unless you have some real strategic IP, I don't see how, or you have some great growth prospects and you need cash. And that's when a private equity firm you can partner with. But I see businesses that are steady, making $1 million a year, nice companies. But their most likely exit path is to either transition into an inside management group, or if they have children, to transfer to their children. And I guess in the worst case scenario is they just do a lot of retirement planning and pull out as much money and sock them as much as they can away and close the doors if they don't have anyone to transition to.
I totally agree. I'm just trying to pull up.
Well, you're doing that, George. Let me ask you. So on this guy that I brought up, this won't shock you, but he's not short of confidence. So I'm doubtful I'll get any, unless I can blow some magic words in his ear or something like that, I doubt that I'm going to get any follow-on work from him. How do you guys deal? Does anyone have any magic words for dealing with someone that knows pretty much everything?
Well,
Steve, I'm just going to ask a question because I just don't know. So have you brought the leadership team in, or is the CEO running the whole thing by himself and whatever he says goes?
Well, until we take the next step, I don't know for sure. I mean, he would say that he's got a strong management team, or he has said he has a strong management team.
So it might be interesting for them just to take Dimension 1 and see if they have the same opinion as the CEO.
Well, that's exactly right. I was going to, Kathy, the senior leadership alignment would be a great way to start smoking this out.
Yeah.
But first the client, has to have the conversation with the client is, okay, listen, you say you're an 82. Well, let's take that at face value, right? All right. Well, what happens if you're, and I'm distilling a 2 or 3 hour conversation into a moment. What happens if you're not? What are all the things that this business needs to deliver down the road? And what if you're wrong? What if you're not an 82? What if you're actually, like most companies, a high 50s, low 60s, which is a good company, don't get me wrong, but it puts the likelihood of all of these things happening in a different light. And what happens if you're wrong? Let's just play that out, right? Let's just play that out. And to kind of pile on that, something that Mike just said. So when we always talk about the business owner and the business owner's family and funding their personal wealth, that is a very important factor. It is also not intellectually lazy. It's we neglect some of the most critical relationships here. And those relationships, if I walked into a $10 million a year manufacturing company and asked the person with the business, the CEO, who they care about the most deeply around them, they're going to start with family. They're pretty quickly going to come to their team, right? And they probably mean all of their employees. But never underestimate the incredible importance of the value they place and the beholden they have to their suppliers, their distributors, their their bankers, those stakeholders in the business those are sometimes, if you've been running a manufacturing company for 25 years, odds are you've been doing business with the same raw material providers for some or all of that time, et cetera. So these become very deep personal friendships. They're business friendships, but they're deep friendships. And those are important conversation points. Okay, so what happens to this matrix you've created, this community you've created? And, because it doesn't stop at your business's walls. So, yeah, man.
I have one other comment just relative.
Go ahead, Steve.
To this. So just for gallows humor, any exit planners here will get a kick out of this, I think. But I gave him another survey that he took, and he indicated that the question is, do you know what your business is worth and how did you get it? Well, he talked to other folks that he knew about multiples that they got.
Yeah, right. That's exact. And that is, and great. But we have to take that information. This is, so you're basically I'd be asking the business owner, perhaps, listen, so you're telling me that you're making your business decisions on anecdotal data, right? You have a qualitative understanding of the value of your business. And it's not worth what you think it's worth because you say so. Again, the ocean will drown you without shedding a tear. The market does not care how cool you are. It doesn't care. The market is. So I was trying to share this with you guys. This is a blog that I have partially written. Go away there. Can you see my screen?
Yeah.
Okay. So let me make this a little bigger. Well, actually, can you see this? Maybe I
think we can see it well enough.
You can see it well enough. All right. I'll make it just a tad bigger. Maybe can we get away with 125? Can we? No, not really. All right. Because then I can't see it. All right. So I did some research, right? And we all know these. I don't think we're going to dispute these numbers. But if you want to go IPO, $100 million of gross annual revenue is kind of the place to start. And you want a private equity to come along, you got to be 10 million or bigger. Rough numbers, right? I know there are outliers. Well, we have a company at 5 million, but generally speaking, 10 million and up. And the higher you go, the happier they are. It's up. Also, about a $10 million a year threshold. You want to do a management buyout? You probably, to have a management team, you have to probably cross the $1 million line, right? It's probably a bigger number than that, but we're setting sort of minimums here. And then to gift it, $500,000 a year, do you have something to actually give away? Now, let's focus on these guys here. So then I started playing with, okay, well, what does your growth capacity and value capacity need to be? And I in looking at the the questions and thinking about how we score. And this is not proven because I don't believe we've had a business do an IPO. However, my guess would be, I would wager digit that you're going to have to be in the, sort of the 80. IPO is private equity, probably growth capacity of 70. That is hard, right? 70 is hard, and value capacity of 85. They're going to, you have to successfully complete due diligence. Let's put strategic deals where we might have a different appetite for risk off to the side. That's an extra layer on top of latent value, right? Transferable value. ESOP also probably cares a little less about growth capacity, but you have to be whistle clean on your documentation, right? MBO, 70-70, probably care a little less about, do we have our governance docs? Do we really need audited financials, guys? You do if you're getting outside funding, but let's say you're holding the paper. So these are just I was playing around with what would this look like, put it in perspective. And then I just created a scatter chart to say, okay, here there's an overlay of the two. Should show purple or something. I'll figure that out. But, here's how it plots out. And I had a conversation with a really impressive fractional CFO the other day. And it's amazing the misconception about value. It's easy to pull valuation numbers out of the market, but we really need to look at, okay, so if we're being told that the range of values for a manufacturing company is 8 to 12, for what size? Those are big. It's 8 to 12 for high quality, high revenue manufacturing businesses. That does not apply to a $2.5 million a year business. Unless you have strategic value. Anyway, I just thought I'd throw that out. It's kind of in line with our conversation.
So is there a diminishing return associated with the gift? And, it's going to cost you $100,000 to change the value capacity from 50 to 60. And, the value isn't, you're spending more than you're gaining, I guess is the question. And at what point should that be a conversation around, this is going to cost too much to, the remodel of the organization is going to go well beyond the cost of the actual potential value on the market.
Well, keeping in mind that this is sort of a minimum that you would be bothered gifting it, right? So typically you're going to be gifting, I would anticipate that a business that's being gifted is probably doing more than that. But let's talk about the ROI, because there are two ROIs, right? That's a great question, Joe. There are two ROIs. One is a financial ROI, but if you're gifting this to your kid, and let's go back to an earlier comment, if you're gifting this, let's say, to your child, your daughter, do you want to make sure you're gifting her? Do you want to gift her a bucking Bronco or, a car that chronically breaks down? Or do you want to gift her a business that is going to be satisfying to run, a business that is not going to make her go through the same agita that you went through getting it to where it is today, a business that runs smoothly and that has a bright future? And I would, doesn't matter what I think the answer is. Let's just think about it from that perspective, because that's the other ROI. So if we do the work to get the business, even without the financial aspect, I think that and that comes down to the growth conversation. That initial conversation with our client, during which, it's okay, well, what if you're going to gift it? That's terrific. What type of quality?
Couple of comments on your numbers there based on some things I've done. The ESOP at 10 million in revenue, you haven't included EBITDA in there. And I had a client who looked at that, and with all the requirements there are with it being a retirement plan,
yep,
you got to have some really good things in there. So maybe think about that. Management buyout at $1 million, I would tend to agree. I got a auto repair shop right now where the owner is trying to pass it on to his favorite employee, but I'm not sure if I did a clarity with them, they would show growth capacities and value capacities in the 70s.
Mm-hmm.
This is more a Main Street kind of company level, and as long as there's cash flow to pay back the loan, and in this case the guy is looking at, he'll take a loan for 10 years at 4.25% in order to transfer that business to his employee. If I did a clarity, I don't think they'd come close to a 50, let alone a 40 in their things. I mean, just they got a good reputation. People come to them to get their BMWs repaired.
Yep, and that's a good business, right?
Yeah.
Yeah.
It's good, steady business. On the private equity, all the stuff I've seen and that I see, you're going to have to be over $2 million in EBITDA in order to get there. So you can be 10 million, but it's the EBITDA that really matters to the private equity groups. And you can break private equity groups into searchers who are funding themselves, or they're going out there finding a company and then finding some capital to do things.
Like
and
an
then
independent
there's
sponsor?
the much larger ones. So, I mean,
Yeah.
there's a sale within my trucking industry. It was a $400+ million company, Safe Fleet, that got bought by Clariance Technologies, which is backed by a big private equity group that bought out Penske's interest in that company.
Nice.
So Peg goes all over the place.
Yeah, they do. And they've got, and PEG is a biosphere, right? There are private equity groups that would never touch a $10 million business, right? That's not the business they're in. And then there are other, firms that like to go down market is pejorative, but they like to buy, they're happy to buy smaller companies, for a variety of reasons. Yeah, I was just playing with baselines and saying, okay, what
I like where it's going.
Yeah. What path are we looking at?
Hey, George.
Yeah.
I think has already been kind of reflected here. You can get a lot of people to line up on have many opinions on that particular chart on the PE, sure. As you're well aware. It's going to depend on whether it's a platform company or a roll-up.
Yes. Yeah.
PEs go a lot lower than $1 million in EBITDA these days, particularly if it's just an add-on.
So along these lines, one of the reasons I particularly came in today, I don't know if anybody looked at it, but I posted something that went to an ACG or a meeting, and somebody there's a free report at Pepperdine University that talks about all of these different things and tremendous amount of information, some of which I can't understand.
That's a great report. It's been out. I think they've been doing it for 5 to 10 years or something like that.
Yeah, it's been a while.
It's a wonderful.
It's a great report, Paul. Yeah.
Okay.
Yeah.
Because it's good because it actually brings you back down to reality in terms of, but it's basically telling you like what are the hurdle rates for these different investors for these different vehicles, right? Like it'll go all the way down to like, a bank account to like asset-based lending to like mezzanine to, And
there was a big section for those of you who do business valuation and are brokers as well on, what they're doing in that section. I like the way they broke it out, but some of their math doesn't seem to make sense to me. And some of their charts, I don't understand what they're trying to say, and they don't explain them well enough to me.
That's a good segue. I just pulled it up. It's the Private Capital Markets Project, and you can Google it up, guys. There's some good information in there. Thank you, Paul. Would you guys be willing to, I'd love to hear your feedback on something that we're designing right now. As I said earlier, I kind of teased the nickname, the CFO Insights. I don't want people to think that only a CFO can use it, so that's why the name is sort of provisional. But
I always have an opinion, George. Go ahead.
Hang on one sec. We'll close this.
You get what you're paying for.
Exactly. Okay, here we go. So guys, I'm going to hit you a little bit with a fire hose. So what happens if we can project information going forward? So let's start with revenue, right? Let's start where it warms the cockles of every CEO's heart. And I need to move our pictures out of the way here. There we go. So I know there's a lot here, so bear with me for a sec. What we're doing is we're taking current gross revenue and we're saying, all right, well, we know how we've input 3 years of data projected for this year and tax returns for the previous 2, for example. So trend line here, actual line is heavy. So if we're projecting revenue, here's the CEO saying, well, I'm going to grow at 20%. Here's where this puts your revenue 5 years out. Here's how fast your industry is growing. And so if you just grow as fast as your industry, well, this is where you're going to be. If you grow as fast as the market generally, all industries, this is where you'll be. So your industry is underperforming the market. And then if we project your growth at your historic rate, if we just take a regression and push it forward, here's where your gross revenues will be 5 years from now. And we'll get into value in a sec. So if we just project your revenue going forward, you're at 19. You're telling me you're going to grow 20%. This puts you at 37. If you grow as fast, so you're historically, pushing it forward. You're underperforming your industry. You are underperforming the market. And then this is an interesting conversation you could approach a number of different ways. And I guess, is this the type of information that you would find useful as you're working with clients? Or trying to
One of the things that I've just investigated and joined the Risk Management Association.
Okay.
And they have statement studies that are available that give me benchmark information by NAICS code over the last 5 years for, depending on the code, the number of different companies that have done that. And that's all from banks and brokers reporting their numbers voluntarily. And it being able to tell a company like Steve's company, you're full of it, you're not that good, because here's how the industry is doing stuff, I think is valuable to trying to get people to engage.
So I totally agree. And if you're willing to share it, I would love to see that data. I pulled actual industry data that's publicly available from a number of sources to come up with this projected industry growth rate. And that is a great, Paul, you just hit it on the head. Love your optimism. How do we back it up? And in fact, you've kind of teased out. So we can do the same analysis for net income, right? Here's your net income if you grow it at the industry's rate. Now, at your historic rate, you're actually doing better on net income than the industry. Then you've put based on your input, here's where you're going to be. There's a disconnect here. It's not that this can't happen. The real conversation is, what do we need to do to make this happen? Because if you keep doing what you're doing, this is where you will be.
Well,
so what do we need to do? Go ahead, Paul.
That high chart there takes you into a slightly different thing, which is, okay, now what's your strategic plan? What acquisitions are you going to make? What new products are you going to do?
Yes.
In order to do that? It's a completely different discussion then.
Yes, that's exactly right. Thank you, Paul. I'm going to ring the bell.
I'm a nice foil.
Wow, my phone is ringing off the hook. Okay, now, if
George,
we get into the value, guys,
works.
Go ahead, Mr. Fullwider.
So to start the analysis, would we input the 2-digit NAICS code? Is 2 digits enough?
Yeah.
Okay, good.
Yes. 2
And
digits
then we would input their current year projection to historical years.
Yeah. So you would do about 20 minutes of data input, and it's very straightforward. And with those, again, like 20 minutes of data input. One of the questions is, all right, well, how fast do you think you're going to grow? Oh, we're going to grow at 20% every year. Yes. Or whatever they think it is. Or maybe they say, I don't know. Okay, great. Well, there's another conversation going back to Paul's point. Well, let's get some confidence here. If we look at the impact that this is having on your go ahead, John.
So another question, building off that, oh yeah, we're going to grow 20%, right? It would be handy if the tool would label your past year-over-year growth rate. They're gonna give us absolute numbers. Mm-hmm. And then the tool would display the relative numbers. And I could say, oh, well, according to this, we're going to grow 20%. You only grew 8% the last 2-3 years, right?
That's exactly right. That's exactly right. Because that's exactly what this blue point is. At your historic rate, you're going to grow your gross revenues 5 years from now are going to be 19. If you keep doing what you're doing, you're going to grow to 19 million. You're underperforming the industry. You're underperforming the market, and your projections. Let's talk about how you're going to get there. You're absolutely right.
Yeah.
Jim.
The way I'm visualizing it is in the your current performance line. There would be a little bracket below it for 2023 to 2022, and a label that says 8%. And then for 2022 to 2021, a label that says 10%.
Yeah.
So that they could see as they're talking in 20% terms, they could see, oh, wow, that's a 12 percentage point difference from what I did just 2 years ago.
Absolutely. And be able to model this on the fly. You're sitting with your client. Okay, well, your current margin is 13%. What if we take it to 16? What impact does this have? And that verification built in.
So George, is this thing up and running now?
Not yet.
Oh, okay.
Not yet, but it is the next thing. So we will have the execute guidance. The guys are working on it right now, and that'll be coming out not the end of next week, but sometime the week after that. And they're also working on the senior leadership alignment, which goes back to another point we made earlier in this conversation. And then this will be the following. So I would anticipate sometime in the second quarter that this will be. Now, can I share this with you if you wanted to run this with a client, can I share it with you as a spreadsheet? Sure. Can I, we'll have some locked cells, but I just want to, what I'm hoping is so you guys seem to be digging into this and saying, okay, we like the direction. So now we just want to make sure we get the design right.
But what do you have a name for it? A preliminary?
Right now, I've just nicknamed it CFO Insights.
Okay.
Not in love with the name, but this is kind of here's a conversation a CFO would have with you. And we're just going to base this on some high level financial information. I'm not getting into the level of detail that a CFO would, but let's talk about revenue growth in the context of the market, and then the impact that's going to have on value. And this is all of the things we could do with value, right? So here's your equity value at the industry growth rate with your current strategic capacity. So if you do not do anything about strategic capacity and you grow with the industry, here's where you're going to add value over time, right? Because you're going to have higher revenues. It's pretty simple. Here's your this red line is your equity value at your manual input. Well, we're going to grow 20% at that rate. And we're also adding a 10% annual. I think that's about the max you can grow, but we'll say, but we're just going to put an imputed 10% strategic growth capacity. Okay, so if you increase your strategic capacity, and we'll show what that number ends up being. And go ahead, Mike.
No, I was just going to say this could be when we do the equity value planning in Clarity One, right? When you show the owner, okay, when are you going to retire, and what does your business need to look like in order for you to get the equity value you need from your business, right?
Yes, and this pulls data from the EV.
So this will show them that if they need to grow and be at a certain revenue level or profitability level, how realistic is that given what you just charted here? Unless they come up with, unless they dramatically change what they're doing.
Yes.
Let's go there for that second. They dramatically change what they're doing, and I guess the question is, and I look at it from storytelling, right? So the great numbers, George, and God love them, and hopefully you can make them. But how does the story behind that? So let's talk about like the sweet spot. Where are you in that growth? What's going to really catapult the company into some other new direction? So I always go to look at your S curves out there. You may have a brand. You may have a particular product line that you're following, and it's actually starting into declining mode. What is that new launch? When do you jump the shark, if you will, or the terminology is? If you start too early, you don't have enough political capital. But if you start too late, you have people running off the boat, right? So when you're talking about this and supporting evidence, you need to have some significant plans out there in place that demonstrate historically how you jump the shark from a product line. I go back to General Electric, or not General Electric, but so it's Philips. Philips has jumped the shark from not only doing picture tubes, then they changed over to light bulbs, and now they're in medical equipment. Okay. Yep. So over the span of like 30 years, they've been able to jump the shark into new things. So what is that story being told by these numbers? That's the juice that's going to get somebody believing these numbers. All the numbers are great, but my case is going back to how are we going to prove these numbers out? Yeah, that's the question, right? What are you going to do? What are you going to do? And then so going back to Mike's saying is that you really need to think about what new different you're going to do in order to generate the growth you need to have that you're forecasting. Yeah, absolutely. And this one doesn't have a trend line for some reason, but yeah, well, and how do we communicate the importance of that story? I could see behind this two different, graphs, one showing historical growth and related to the products, whatever you're doing, and then forecasted based on new, different, or double down or whatever it is. But what's the story and how you're going to get there from a graphic perspective there? Yeah, we don't dig down onto the product. What I'm trying to communicate is
all right, here's what happens here's what happens if you grow as fast as the industry, but you work on strategic capacity, right? Let's work on the quality of your business. It has a profound impact on value, right? So here's your enterprise value at the low multiple, right? At the industry growth rate. Here is your value here at the high multiple. So if you increase the quality of your business, this is a $10 million swing.
Well, I go back to the people required to get all this done, right? So that's the growth capacity piece, right?
Yep.
So the ability for them to historically grow and put on, talent and, process and all that. So,
yep.
Okay.
Yeah, sure. One more. You've got to manually input growth rate. So this is, again, you've said, I'm going to grow at X. So your enterprise, your equity value at your 20% growth rate. And so if you're going to need to do something to generate that 20% growth rate, that's compound, year after year. That's robust growth. You're going to need to do things to the business. If you do increase the quality of your business, if you do make sure that do the things that will ensure that you can hit that 20% growth rate, here is where, here's what the impact it'll have on the value of your business. And if we go back to industry growth rate, right? Here's your top multiple at the industry growth rate, 19.4. You're projected, you're personally, by the way, they're pulling that number out of, and it's an educated guess, right? An educated goal, 33.7. That's a profound delta. And then here it is again. If you grow at your historic rate, if you just grow at your historic rate and you don't do anything to grow your net income, in this case, it's a manufacturing company, EBITDA, but you work on the quality of your business. By the way, revenues will pop. We all know that. But if we just project it out and all we've done is worked on the quality of the business, you're going to start getting into, this is forward looking and not a guarantee, but we're just modeling this out. We end up with a $16 million business. And that's pretty good. You're still not at the high multiple, by the way. You're still under the market's, not premium, but the top end of the market. This is simply by increasing the quality of your business. And Madam CEO, what in our experience you will see is that actually your margins will increase, your net income will increase, your gross revenues will increase. It will happen organically. So I just wanted to share these with you guys.
George, I see this. I kind of see this as testing. When we get to the equity planner, right, in 31, yep. Right, and someone says, I'm going to leave in 7 years. Well, what does your business need to look like? And you show them what the top line is and what the bottom line is. Then you can test and you could show them, if you want to get to your goals, you got to be at this level. Then you can test that projection by using this tool and say, well, wait a minute, you'd have to grow way above the industry average, and so how are you going to do it? So say you got to grow at 15% a year. Oh, okay, I guess that's my goal. I got to grow 15% a year. Yeah, but you know what? Historically, you haven't, A, and B, you're way above industry average. So you have to come up with something very novel to get there, or you have to change something else in your planning, like your expectations.
That's exactly right, Mike. That's exactly right. Yeah.
Same thing that Kathy said earlier on a different topic. Okay, that's fine. Show me.
That's exactly
right. George, you said something. You said Mr. CEO. So perhaps instead of calling it the CFO Insights, it should be the CEO Insights. I'm just saying, because
I like that.
I'm just saying this is really a CEO kind of. Yeah, the CFO will deliver this. But what insights are, you're really appealing to the CEO, I would think, not the CFO.
You could also call it growth drive insights.
Or that, right. Because the CFO insights, that you're kind of pigeonholing it if you call it that. And then a CFO may see it as a threat.
Yeah, and that's a couple things I've done along these lines to help people understand what it takes is within the trucking industry, I'm able to look at public companies who report on their margins, on their SG&A, on their inventory turns, and a variety of other things, and they do it against their public competitors. Yes. So PACCAR, for one, does a great job of showing 10 years of data how they have outperformed their peers. Mm-hmm. Another thing I've done with companies is Alpha Sites allows you to put together a portfolio, and you can get information from it then. So you can take a private company and you can ask them, well, what funds are you invested in? what companies do you think are good companies?
Yeah.
And we'll compare what you're doing against what they're doing because they're public. I can get their data and
Yes.
show you you're not doing so hot. And,
Yeah.
and so frequently I find they think they're growing, but they're not growing even as fast as GDP. And so they're actually losing in the process.
Which is why I put the market line in there. I totally agree, Paul. I totally agree. Yeah. Great conversation. Thank you. We lost a few people running up into 10:30. I can't believe it's been an hour. This hour flew. Any questions before we break for the week?
Am I done for the week? Excellent.
No, until just this coffee klatsch.
Oh, okay.
All right. Awesome, guys.
Take care.
Thank you. Listen, terrific conversation. Thank you very much. Kathy, Steve, Paul, Joe, we'll see you soon. Thanks. Have a great week.